All right, guys, most sectors green. We're being led once again by some of the reopening names in the financial and energy space. Let's get to Bob Pisani. Hey, Bob.
That's exactly what's going on, Carl. It's the reopening again. And why shouldn't it be with the earnings that we're getting and the reopening news proceeding apace? Tremendous economic news on top of tremendous earnings. No surprise. Take a look at the sectors. Carl's right. It's energy and banks. It's the reopening sectors. We're also seeing some industrials up. Tech's doing okay. Defensive names like REITs, utilities, they're lagging. So this is the reopening story. And if you look at the leaders in the S&P leaderboard, I look at the S&P rather than the Dow, you see it's all the reopening names once again. So you get UPS, another new high. FedEx is not far. Material names like Freeport McMoran and industrial slash high-end consumer names like United Rentals. Also doing really well today. Remember, everybody, we're about 60% through earnings season. 300 companies reported. Not only is the numbers blowout, but the guidance is very good on top of that. So remember, 60% reporting. We're essentially up close to 40% compared to the first quarter of last year, or close to 50%, excuse me. But the beat is what's important. 23%. Those are titanic numbers. Remember, historically, the beat used to be 3 to 5%. Now it's 22%. So the analysts have been consistently wrong. This is one of the reasons the market is still up. And there's a number of reasons why we're at new highs. And the most important thing is the earnings growth is much better than expectations. But we also see the reopening proceeding. We see the economic data strong. The economic data is also above expectations. And finally, of course, fiscal monetary stimulus is continuing. You put this all together, and it's no surprise you've got markets at new highs. But let's talk about why is the S&P up like 13% this year. We'll go back to the old Jack Bogle principles. Jack used to say at Vanguard, there's 3 reasons why stocks prices move: earnings growth, dividends growth, and the multiple increasing or decreasing. So earnings are up for 2021 about 10% compared to the start of the year. Dividends estimates are going to be up about 5% this year. Right there, you've got 15% growth. There's the S&P up 13% right there on the earnings growth and the dividends growth. The PE ratio is about 20 now, for including 2022 parts of that. That's been going down. That's generally good. And liquidity, there's been huge inflows. I'm waiting for the May numbers to come in for mutual fund and ETF inflows, but they're going to be very, very big. I should have those numbers later today. A lot more money coming into the stock market. The one problem, if you really want to look at what's going on, is the S&P, we hit when earnings started April 14th with J.P. Morgan. Essentially, we're flat since then. And Carl, we're up, less than 1%. That's an indication. All the growth was in the end of March, beginning of April. Since we started earnings, it's basically flattened out, and that's the problem. This is that peak idea, peak earnings, peak economic growth, peak reopening. A little harder to move the markets forward from here.
Shepard Smith here. Thanks for watching CNBC on YouTube.